So our portfolio, it's an absolute return, long-term oriented approach with a few primary objectives. First and foremost is capital preservation. Secondarily, what we're trying to do is have the upside of equities, but with substantially lower volatility. So over a full market cycle, what we're trying to do is have equity-like returns with substantially lower volatility. And we really do this through three key things. First of all is our long-term focus. In a world that's ever increasing in terms of being bombarded by data on a day-to-day, minute-by-minute second, rather than trying to figure out what a company is going to look like in the next quarter or the next year, we're looking out 3 years, 5 years, and beyond, trying to figure that out. Secondarily, what we're trying to do is invest assets as we would invest our own. And this really frees us up from doing things differently. So we don't feel obligated to hold certain sectors, certain geographies, or certain names in a given index if we don't like those investment prospects. If we wouldn't own them themselves in our own personal account, we wouldn't own them on the behalf of clients. And then finally, what we're trying to do is try to not lose money. It sounds simple, but a lot of times in the industry, I think we forget about basic math, and that's you grow your assets at 7% for 10 years and you'll double your money. If you lose 50%, you need just 100% back to break even. And Warren Buffett was famous for his golden rules of investing. Rule number 1 was don't lose money, and rule number 2 is please refer to rule number 1. And we largely agree with that. Sure, so there's a wide universe of securities that we can choose from, but we have very strict criteria for names to enter the portfolio, both on the equity and the credit side. And largely the characteristics are similar. So first of all, what we're looking for is durable franchises that will be around for the next many decades. And those type of companies come about because they have a clearly identifiable and sustainable competitive advantage. So think of a wide economic moat that's due to high barriers to entry, or it's an operator as one of few operators in a given industry. There could be high switching costs or a very loyal customer base. So there's a lot of things that can define that type of advantage. Another thing that we look at is the financials, which probably isn't a big surprise. We want to see good revenues, good profits, good operating margins, good cash flows, but we never want to see those being too high, because a lot of times that means a company is over-earning, it is potentially overpricing its things, or it's potentially not investing and reinvesting in the business. We like strong balance sheets with a lot of cash, very little debt, if no debt at all. We like to see a company that has assets on its balance sheet that are stable, that don't depreciate and can actually appreciate over time. We also do a lot of work on company management. A lot of CEOs today for public companies are being incentivized on short-term quarterly earnings, and that gives them the incentive to maximize short-term profitability at the expense of the long term. We don't agree with that. What we're trying to do, because of our long-term approach, we're trying to invest in companies that also have a long-term time horizon, that are thinking about the next 10 years and beyond. And then finally, the hardest thing in this environment, quite frankly, is the valuation. We would love to say we want to find cheap companies. Cheap companies are hard to come by now. The market's run for about 10 years. So what we want to do is make sure that the price that we're paying now, we're comfortable with as we think about our time horizon over the next 5 years, over the next 10 years. And does that offer us a margin of safety if the markets do go down? Sure, so I think that's an interesting question, because 2018 we finally saw a return of volatility. And it was a year, if you look at the calendar year of 2018, the MSCI World was down 9%, and our portfolio was roughly flat. So how did we do that? Well, it comes down to the flexibility of the portfolio as well as the security selection. So about half of our performance has been generated on that downside from we hold cash, we hold US Treasuries, and we hold some put options, which all helped performance, but that was only about half of it. The rest came down to security selection. So those securities in aggregate were down about 9%. When you look at the market index, we had a number of securities that were positive. We run a very concentrated portfolio. So a number of our names were up, 20%, 30% to the upside while the market was down about 10%. Now, another thing too is that because we're flexible, we don't pay any regard to a benchmark. We don't hold securities that are in energy, that are in materials. We hold very little in financials. These are all areas that did pretty poorly last year. By avoiding that, we also did well. Political instability is certainly something that I think all investors think about, and I think for any portfolio manager, understanding the risks to your portfolio in totality is ultimately one of the hardest things that we can do. I think when you think about political instability, it's not something that we try to measure and calculate into the portfolio with any degree of accuracy. We largely believe any attempt to do so is a waste of time. A lot of times these are binary decisions that are completely unpredictable. The politicians themselves don't frankly know what's going to happen the next day a lot of times. So what we try to do is focus on durable, resilient businesses that will thrive under any regime, under any market condition. They'll participate well when the markets are going up, but more importantly, will protect better when the markets are falling. So what we think about first is what can go wrong with an investment rather than what can go right. So we think about that, and if the risk-return trade-off is appropriate, that's when we would invest.